Dr. Michelle. That was a sort of a good introduction. So I guess there's no need for me to say any more about myself. I'll just move sort of straight into my talk. My talk is on something called the real options approach to entrepreneurial finance. And one of the things essentially that I'll be promoting here is the use, shall we say, of financial models for entrepreneurs. I teach a course here in Calgary on business and financial modeling. And what the students do in that course then is, after they learn the skills on financial modeling, they essentially link up with small businesses, mostly in the city of Calgary, but sometimes outside the city of Calgary. And they meet with them to discuss what sort of needs they might have in terms of a financial model. So it could be a forecasting model, it could be a capital budgeting, a cash budgeting model, or it could be, for instance, a real options valuation model. So as part of my talk, I will sort of show you then the sort of spreadsheet model that the students would build for companies to be able to use in terms of helping finance their growth or helping plan for their future. So I'll start then by saying that Forbes magazine has identified that the number one reason that most entrepreneurial ventures fail is that they have a lack of adequate capital. That is, there's inadequate funding, especially funding for their growth. Okay. The number 7 reason, and so there are reasons in between, but the number 7 reason is sort of poor planning. And so this talk is sort of all about the issue of financing for entrepreneurs, and this approach that I encourage that you consider if you are an entrepreneur or a small business. And it's also then this approach, this real options approach, also allows for what's called strategic planning and sensitivity analysis and scenario analysis along the way. So I'll start with sort of the basics, and that is what is financing. So when an entrepreneur goes to the bank or meets up with a private equity investor to ask them for money, why would the bank lend them money? Why would the equity investor lend them money? What do they get out of it? And so at a very basic level, we say that financing really is selling your future cash flows. And it really depends then on where the cash flows are, shall we say, in the income statement. That determines then the type of financing that you would use. So for example, it's possible that you could sell off some of your sales, in which case then the type of financing that you'll be using is royalties. Okay. It's possible, for instance, that you could sell off some of your operating income, the EBIT, in which case then you'll be essentially getting financing through a partnership. It's possible you sell off interest payments, and that of course is debt or borrowed money. And then at the bottom, it's possible then that you could sell off then the net income after taxes and so on. And that then is an equity, shall we say, investor or equity financing that's there. The two most common, shall we say, methods of financing then, of course, are borrowed money, which the cash flows then are interest payments and then the net principal payment, and then private equity, at least for small businesses. Public equity, if you become large enough. But for small businesses, private equity, which could take the form of angel financing or venture capital financing and so on. And here, dividends then are the cash flows. But more importantly, there's what's called the exit value of the equity. So when the equity has reached a certain level, the private equity investor would be looking for a valuation and an exit strategy in which they can recover their money. So most new ventures essentially are financed with private equity. And this is because the banks themselves, so even though lenders would lend you money, lenders like to see a history, shall we say, of cash flows in order for them to determine, right, what sort of interest payments you can make, what the probability is that you'll pay back and so on. And if you are a small business, if you're an entrepreneur, if you're a new venture, you often don't have that history of cash flows from the past. You don't have a history of financial statements that lenders need in order for them to be able to assess the risk involved in lending you money. And so private equity tends to be then the way that most new ventures, most new entrepreneurial ventures are financed. Okay. Now, when a private equity investor decides then that they're going to invest in your firm, okay, essentially the question they are looking at is what sort of value can we place on the firm? That is the future cash flows that are being promised to them. How much are those future cash flows worth? Okay. And this, of course, depends on the size of the cash flows in the future. That is this firm will generate, the timing, that's when it will come. And for a new venture, typically at the beginning of its life, there may be no cash flows or even negative cash flows. And then the cash flows would come towards later on in the life of the firm. And then finally, the equity investor would also be trying to assess what the riskiness is of those future cash flows. And so the way they would finance it is once they figure out all these things, the amount, the timing, the riskiness, they now say, well, this is what the value of those cash flows are, the future cash flows. And that is what you can sell the equity in the firm for. So we say then that the value, okay, is really then the present value of future cash flows. And the most common method that's used to determine this present value is the so-called discounted cash flow method, where you look at the riskiness of the cash flows and you assess, you use that to determine an appropriate risk-adjusted discount rate, okay? So the typical discounted cash flow method then has these steps. Step one, of course, is you forecast out your sales and revenues to the equity for a period of years. And from the revenues, you forecast out what the profits are to the equity of the firm. Step two then is you estimate at the time at which the equity investor is going to exit the firm. And equity investors are always thinking about this exit strategy, okay? Typically then this would either be a sale back to the firm, it will be a sale to a strategic buyer, or, you know, if this venture, for instance, is a really big hit, then this could be through an IPO, an initial public offering on, say, a stock exchange somewhere, okay? Step three, once you have that sort of terminal date where the equity investor will be exiting, you value then that the exit price or the exit value of the firm. And usually then you use a multiples approach that's based on, say, some industry specifications or based on what's called a capitalization rate. And so the two are equivalent. The capitalization rate is really 1 over, shall we say, the multiple, and the multiple is, 1 over the capitalization rate. And so you look at the industry or comparable companies to see what they are trading for relative, shall we say, to the cash flows or the profits of the firm, and then use that multiple. Step 4 then is once you have the cash flows up until the exit date, and you have that exit value, you discount everything back to today to get the value of the firm. Now, for a new venture, right, the discount rates are fairly high. They range somewhere from 25% to 80% as a discount rate. And we'll ask ourselves why that's the case. But once you have that, you end up with the entire value of the firm. And then now you have to decide how much of the firm, how much of the future cash flows do you want to sell off to the equity investor? Are you willing to sell off 50%? Are you willing to sell off 40% and so on? And that determines then what the equity investor is going to invest in the firm. Now, of course, both the equity investor, so the venture capitalist or the angel investor, and the entrepreneur, they have to come to, shall we say, an agreement on what these steps are. They have to come to an agreement on what the forecasted cash flows are. They have to come to an agreement on what the discount rate is and so on. And that often involves a real sort of difficult negotiation process. I have written a paper, for instance, on the power dynamics involved with venture capital negotiations and entrepreneurs, and the process can be challenging. Okay, getting the venture capitalist or the equity investor to agree with the entrepreneur on what the forecasts are, what the correct discount rate is, what the correct multiple to use for the exit strategy is. Okay. So the discounted cash flow method, okay, while it's the most commonly used method, there are certain, shall we say, limitations with it. And this is especially when dealing with the valuation of new ventures, okay? So, and here are the main limitations of the DCF. One is the discounted cash flow method. It really works on what are called expected profits or expected cash flows in the future. So it takes these one numbers each year and say, this is what we expect to make in sales and profits, next year. This is what we expect to make in sales and profits the year after, and so on. And it doesn't really consider alternative scenarios, what could happen, under different settings. The other thing then is it doesn't consider that the riskiness of the cash flows can change over time. So it usually uses a single discount rate, a single risk-adjusted discount rate, which implicitly assumes that the risk of the cash flows is the same over time. And so it doesn't consider that from year to year, the risk might be different. Okay? And this is particularly true of new ventures. Initially, there'll be a fair amount of risk at the beginning, the first year, the second year, and so on. But then once the business gets running, the risk in the cash flows will actually come down a bit. And so the discount rate that should be used should actually come down a bit. But the discounted cash flow method doesn't really account for that. Finally, it doesn't really consider that the entrepreneur, shall we say, has flexibilities in the future. And these are flexibilities essentially that can enhance the value of the firm. So even though the entrepreneur may be doing something now, if the situation changes, the entrepreneur often has an ability to take action that will enhance the value of the firm in the future. Now, in finance, we call these flexibilities real options, and hence we have this term, the real options methodology. And they are called options because they are at the discretion of the entrepreneur or manager of the firm as to whether or not they would exercise these options, whether or not they would take advantage of these flexibilities or not. And it really then is dependent on what the situation is. So in certain situations, they may decide to take advantage of an option they have. In other situations, they may decide not to. Now, we have these options in finance that happen on financial markets, and these are called derivatives. But real options are called real because they're essentially options related then to the real assets of firms, real options. So here are some examples then of these flexibilities or these real options, shall we say, that new ventures typically have. One is a follow-on investment, and this one they usually have. So you start off with a new venture and you see essentially how the market goes. And if the market really picks up, you often have the flexibility or the option, shall we say, to expand, to crank up your production, for instance. Or you have the flexibility to sometimes crank down your production if things aren't going well. So you can expand or you can contract, and you have that. Then, of course, if things just collapse completely, right, you always have the flexibility to stop operations. Okay? And this is called the abandonment option. And it turns out that abandonment option actually has a fair amount of value in it. And so we'll take a look at an example to sort of, I'll run through an academic example, okay, to just to sort of give you a feel for why these things are important, and also two, to show you how you can implement the real options approach in an Excel spreadsheet, in a spreadsheet model. Another option that firms have is what's called the timing option. And this is, you often have this chance of, do you start production now or should you start production later? Do you start 1 year from now or should you start later, and so on? And so you can decide. So oil and gas companies, for instance, they can wait to see what oil prices are. And when oil prices get high enough, then they can start production. And that, rather than just start production now when oil prices might be relatively low. And finally, of course, there are options with regards to flexibilities in operations. And a classic example of this then is in the operating leverage. That is the labor to capital mix. So sometimes you have the option to become more labor intensive or become more capital intensive, depending on how the situation then unfolds, shall we say. For instance, if the labor market slows down and labor becomes cheap, you can make your firm more labor intensive and so on. So I think what I'd like to do now then is to sort of just run through an example that would show the power, shall we say, of using this method. Okay, it's a fairly straightforward example, and what we'll do is we'll first take a look at the discounted cash flow method, and then we'll take a look at applying the real options method then, and see the difference and see then what the advantage would be of the real options method. So this is an example. And as I said, my students here at Mount Royal, they typically then would meet with small businesses and they would sit down and help design, shall we say, spreadsheet models, and then they would present it to them and then hand it over, to them and so on, so that they could use it in the future. And these businesses here have expressed appreciation for these models, and have said that they use them quite frequently. So in this example here, we have a food canning venture, and based on, so I would say, the local demand, the current local demand, the new venture is going to forecast what the demand will be in the future, a year from now, 2 years from now, and so on, based on sort of what a market survey has seen demand to be now. They also will forecast what the prices can be and what the expenses will be, and then they'll assume a terminal exit time and then forecast what the exit multiple will be. So here are some numbers then that will work with it to the example here. The current demand based on the market survey is 5,000 units. The price per unit is $100. So this would be for a crate of canned goods and so on. The variable cost per unit is $10, and the fixed cost then is $250,000 per year. Now, at full production, the firm has forecasted that next year the demand, shall we say, for their product will be 6,250 units. In year 2, it will be 6,680 units. And in year 3, it will be 7,140 units. And then in year 3, this is the year then they will assume that the equity investor would exit. And so they'd be looking to get then a terminal value on that. So in terms of the demand for units then, this is sort of what the timeline would look like. Currently it's 5,000 and so on. And then at time 1, time 2, and time 3, we mentioned them, these were the forecasted expected demands, okay? The cash flows then based on that expected demand would essentially use these operating expense forecasts and the price and so on, and would crank out then cash flows or profits of demand times the unit contribution, that's price minus variable cost, plus then the fixed cost. Actually, this should be minus the fixed cost, I think. So that should be minus the fixed cost. But if you calculate that using those numbers, then you end up with expected cash flows each year in dollars of $312,500 for the first year, $351,200 for the second year, and $392,600 for the third year. And based then on an exit multiple of 10, so times 10, that is a market capitalization of 10%. the terminal value then is 3.9 million, or 3,926,000. Okay. And so if you apply then a discount rate of, say, 25% and discount all those numbers back, the cash flows and the terminal value back, you end up then with a present value of the firm of 2.6 million, or almost 2.7 million of the firm. And this essentially is how much the entire firm is worth. Okay, the whole firm is worth. And so if you, the entrepreneur, needs to raise 1.5 million in order to get this firm running, it means then that you have to sell off 55.6% of the firm. That is, you'll be selling off 55.6% of the profits of the firm to this equity investor. If you're only willing to sell 40%, and most entrepreneurs are unwilling to sell off a major stake in the firm, that is more than 50%. And if you're only willing to sell off 40%, that means you can only raise, shall we say, 1,074,000, which might not be sufficient for your needs. Okay? So this is what the discounted cash flow method sort of has come up with. And it turns out that this doesn't capture the full value of the firm because of those limitations, shall we say, that I mentioned before. So suppose these were the scenarios then. Okay, before I get to the different scenarios that can happen and the real options approach, I'll just talk about the discount rate. And so venture capitalists have been surveyed before as to why they have these high discount rates, 25%, 30%, 50%, 75%. And their claim essentially is that, well, one, at the beginning, since there's no history of cash flows, there's all this uncertainty as to whether the firm's product will actually make it in the market or not make it. So there's an additional level of uncertainty that they have to be compensated for. They also claim, because it's a private equity investment, that it's an illiquid investment, and if they want to exit, they have to either sell it back to the entrepreneur or look for a strategic buyer, which could be problematic. And so they need to be compensated for that illiquidity of their investment. Then, of course, private equity investors, venture capitalists, and angel investors, they often, shall we say, provide additional services. They provide management services, they provide networking, they provide contacts, and so on. And so they provide some of their experience. And so they claim, because they are providing what's called smart money, they are providing additional value, they should be compensated for that, but with a higher discount rate or higher rate of return. Finally, as I mentioned previously, equity investors often have a lot of bargaining power. So the entrepreneur may not have a whole bunch of private equity investors lined up looking to invest in their firm. And that gives whatever equity investor they come up against, that gives them a certain amount of bargaining power. And so these are the rationales that are given as to why the discount rates are high. And that's okay. But one thing is that, especially for this additional uncertainty, if the equity investor thinks that the projections are overly optimistic, they shouldn't use a higher discount rate to compensate for what they think might be overly optimistic projections. Instead, they should work with the cash flow projections and so on to bring things in line. And so, working with the cash flow projections, working with the different scenarios to see what could possibly happen, this is sort of the real options approach. And so we've seen then that the discounted cash flow method has a value then of 2.7 million here. The real options method then is what we'll take a look at now. So the first step of the real options method is to sort of forecast what the different scenarios will be in the future, rather than look at just one possible expected scenario. So you essentially have a distribution of what could happen in the future. And usually it's a binomial distribution that expands out. So suppose, for instance, the forecasted scenarios are, in the first year, okay, the so-called make or break here. The demand for the product will be high. So it'll either double from, say, the current 5,000 that they're seeing, in which case, you'd say your product is a hit, and that's great, or it will decline in half. In this case, then your product is sort of a dud, and it's not going to make a whole lot of money. It might still make money, but it's not going to make a whole lot of money. We estimate the probability of a hit at, say, 40%. Let me change that and just estimate it, say, to be 50%, okay? At 50%. After the first year, then once the firm is up and running, whether it's a hit or a dud, because the product is now in the market and consumers now know about the product, demand will either increase by 25% or decrease by 20%, depending on whether demand goes up or goes down, and who knows what it's going to do. And this will continue to happen, but then we'll project that out only for 2 more years, because at the terminal year, year 3, we'll then use the exit multiple. Okay, and so this is kind of what the projections would look like. Right now, demand is at 5,000, and this is not what you've made; it's just what the market survey has said people would demand now. And if it's a hit, then it'll go up to 10,000. If it's a dud, then it'll go down to 2,500, and there's a 50-50 chance of going up or going down. After that, then it'll go up by 60. It'll go up essentially by 25%, or down by 20%, essentially in the market, with a 60% chance of going up or going down. And it's the spreadsheet essentially uses something roughly smaller than 20%, but approximately 20%. So the numbers there, that sort of explains the numbers that are there. And then the following year, it's the same thing that happens again. If it's gone up to 12,000 units, right, then in year 3, it'll increase again by another 25% or decrease by 20%. The same thing too when it's down. If it's at 2,000 units, it'll increase or decrease by 25% and 20%. And so these are the expected demand figures here, and these are the different scenarios. And the question then is, with these different scenarios, how do you calculate the expected demand, and how do you calculate the expected profits and so on? And how do you take into account, shall we say, real options that might happen? Okay. So here is what it sort of looks like in the spreadsheet. Okay, and I can show you the spreadsheet then right now. I can show sort of the spreadsheet right now, and this is. Can you see that? Okay. Okay. So this is the demand. So whether it'll go up or go down, this is the demand, and from the demand then, what we can do is we can calculate what the expected demand is. And the expected demand, of course, in year 1 would simply be 50% of this, of 10,000, and 50% of 2,500. So this would be the expected demand that's calculated there. The expected demand in year 2 would be the probability of getting to here, 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 multiplied then by what the demand is, and you end up with this sort of demand. And the expected demand here is the same thing too, and you end up with this demand. And you will note then that these expected demands, essentially, these expected demands match then the expected demands that the discounted cash flow method uses. Okay, the 6,250, 6,680, and so on, 7,140. It matches then the demands coming from these different scenarios. Once you have this expected demand and so on, the discounted cash flow method will take those expected demands, calculate the profits in each year using essentially sales, variable expenses, fixed expenses, and so on. And then with these profits, it'll calculate the terminal value. And with the terminal value, then it gives you the present value of cash flows. So this is the discounted cash flow method. The real options method instead would say in each scenario, what would the profits be in each scenario? So you'd calculate then the profits and cash flows in each scenario. And so here, using the price, using the variable costs, using the fixed costs, in each scenario, you calculate the price and so on. And then from that, you then discount these back, okay? You can then calculate what the expected values are for each scenario, and you pretty much get the same expected values you get right in the discounted cash flow method. But there are a couple of things that will be different. One is if you use the same discount rate, then yes, you'll get the same value as you have with the discounted cash flow method. And that's this same value that's here. That's 2.7 million. If, however, you allow that this first year is much riskier and these last 2 years are not as risky, and so you use essentially two separate discount rates, and there is a method that you can use to determine what the correct discount rate should be for year one and the other methods there. If you do that, you actually will end up getting a different value up here using the correct discount rates. So you'll end up $400,000 more just using different discount rates because you have different scenarios. But more importantly, I would say, so I'm still going to stick with this here. More importantly, we can see that under certain scenarios, right, the firm should exercise its options. One easy option it should exercise then is the option to abandon. So the option to abandon says, if the market is a dud, right here, and so because your demand and so on was really low, and so the amount that you're making is not enough to cover your fixed costs, so you're losing money here. Should you stop the firm there? And the answer is no, not quite yet, because even if you continue on, it's possible the firm can recover a bit. You won't make a lot of money, but you'll make some money if demand goes up and goes up even further. However, in year two, if it still goes down, then you can see that there is no possibility of making any more money in the future. And so in year two, if the firm is down here, you should stop operations. You should so-called exercise your abandonment option, okay? And if that's the case, then these negative cash flows will actually turn out to be zero. And so if you look, if we put then the first real option, which is the abandonment option, and we just take the negative cash flows then to be zero here, and this one would also be zero up here, so it cuts in half. It turns out then that the value of the firm goes up because you are no longer generating these negative cash flows. The value of the firm then increases by a certain amount just by exercising the abandonment option. Then there is, we can consider another option, okay? And that is, we can consider then another option, and this is the expansion option. So we say, suppose, for instance, that the firm, we've seen the first one, it can cease operations, but the more important option is, suppose in any period, okay? So at the beginning, the firm essentially can spend $500,000 to increase next year's operations. And the way to look at it is, for instance, is the firm is going to lease a machine, and they can lease an additional smaller machine to essentially, or an additional machine to essentially increase their cash flows by 50%. And if you do that, then you move on to the next year. The next year, you can lease the additional machine again and increase the cash flows for the following year by another 50%. And each year, the firm has this option to essentially lease that machine and increase the following year's cash flows by 50%. Now, it turns out that if you do the analysis, then especially if you do it in a spreadsheet, that the firm will only exercise this expansion option. If I go back here, it'll only exercise the expansion option, right, in this state here. That is in year 2, if the market is really good. It could expand it here. And the initial valuation of the firm, shall we say, just assume that the firm was going to go right ahead and expand over here, and that would be that. But if instead it didn't exercise the option and it waited to expand it here, then what you find is that the value of the firm then, with both the abandonment option and with the expansion option, actually goes up then to 3.7 million. But in addition to that, okay, because the value has gone up by so much, it turns out that because you don't spend 1.5 million at the beginning, you only spend 1 million at the beginning, you don't have to sell off 55% of the firm. You only sell off now, it turns out then, you sell off 26.6% of the firm, and then you wait and see, and if things go really well, then you exercise the option, you raise an additional 500,000. But by that time, the firm is extremely valuable, and that additional 500,000 that you're going to raise will only be an extra 3.4% of the firm. So in total, you'll end up giving up less than 30% of the firm, and you actually end up then with more value. So what the real options approach does then is allows you to plan for what's called staged financing. And it allows you, not just you and the equity investor then, to use the staged financing to extract more value from the firm, and by giving up less equity in the firm as well. Which is why I really encourage that if you can develop, shall we say, this real options approach to financing, it will provide you, like I said, with more value, and you give up then less equity in the firm. So to sort of, let me. So to sort of summarize again, the gain in the value of the firm is what's called then the value of the real option. So it went from 2.7 million to about 3.7 million or so. And that gain then is simply then the value of the options, the real options in the firm. And what it turns out then that for most new ventures, the beginning of the firm, the cash flows are either negative or non-existent. And so all the value, or most of the value of the firm, actually comes from these expansion options that can happen in the future if things go well, which is why equity investors actually like stage financing. And my spiel here is to encourage, essentially, encourage entrepreneurs to look for staged financing as well, because it helps entrepreneurs as well. Okay. Now, so most new ventures are like that. Of course, to implement this real options approach then to equity or entrepreneurial financing, it generally means then that you should have some sort of spreadsheet skills. Now, if as an entrepreneur you don't have them yourself, you can certainly go for it. And I'm not sure what happens at Berman U, but you might have students there that can help entrepreneurs essentially develop the spreadsheets they need. We certainly do that at the set, like I said, in this course of mine. But there is an organization here in Calgary called Momentum Canada, where they work with entrepreneurs. And what they do is they take a cohort every year of of about 12 entrepreneurs. And throughout the year, they help them learn spreadsheet skills to essentially do cash budgeting, scenario analysis, sensitivity analysis, and so on, and this real options approach. They tend to work with entrepreneurs that are from disadvantaged groups. So for instance, people with disabilities and so on. But what they have found, because these entrepreneurs have training now in spreadsheet applications, in this scenario approach, in cash budgeting, they found that the failure rate from entrepreneurs coming out of their program is down to 20%. While in the open market, shall we say, generally the failure rate is much higher at 90%. And so this training, shall we say, this mindset of looking at different scenarios and so on, looking at this real options approach, can really reduce the probability of a business failing. Okay. So that, I think, would be all for my talk. I don't know, is that am I out of time?
Yes, you were on time. We're just going to ask our audience for a little bit of a patience. If you can give us 15 minutes for Q&A.
Sure.
Yeah, I don't know if you can give us that as well.
What?
I'm going to ask the audience if you for your questions, you can either raise your hands. I'm moving to full screen here as Dr. Osakwe can stop sharing, and we move to full screen so that I can see your hands if you raise them virtually, or you can write your questions in the chat. We will read them to Dr. Osakwe. So please give us about 15 minutes because of technology glitch. We started a little bit late, sorry about that. So my first question is, you kind of answer it at the end, because there is a very high attrition rate of small businesses in this country, both in Canada and the US. And as you have rightly pointed out, finance is one of the areas where the businesses fail. So I was going to ask whether there is a relationship between the entrepreneur's profile and the financial performance on the ground of what you presented tonight.
The entrepreneur's profile and the financial profile, or the financer's profile?
Performance.
Okay.
Is the fact that entrepreneur is well aware of those methods and how to manage the finance using statistics to anticipate demands and the cash flows, yes, and discount them appropriately. Yes. Is that knowledge of the finance, I would say basic finance, knowledge or the lack of it plays a role in either the venture is successful or not?
Yes. So what happens is that most of the time, okay, if not all the time, the equity investor, the financier, right, will have better knowledge about valuation techniques, okay, than the entrepreneur. And so because of that, and they would use some technique like this, they may use some other heuristics. But what happens then in the negotiation is that the entrepreneur, because he essentially doesn't have that skill, okay, will sometimes clash with the financier. So they end up with two different valuations. And if they end up with two different valuations and they can't reconcile, they can't negotiate to a common point, then the negotiation will break down. There'll be no financing, at all. And that happens frequently. Okay, if you even watch the Dragon's Den and so on, you see this happens frequently. So it happens frequently. The idea then is, if the entrepreneur has knowledge of financing, it's easier then for the entrepreneur to convince the financier that, look, this is why I think my firm is worth this much, and show them the numbers. Okay, if the financier sees the numbers, like for instance, sees a spreadsheet like this, the chances of being financed, and this is even true if you go to a bank. If you go to a bank and you present, for instance, your cash flow projections out on a solid spreadsheet, your chances of getting a bank loan, a small business loan from the bank, go way up. Okay? Yeah.
Yeah. So, any other questions from our audience tonight? Okay, so another question I have for you, because I pay close attention because I'm in this area as well, to the discount rates of the venture capitalists. I'm asking a question that would be not so technical, but maybe a kind of value judgment type of question. Do you believe that they are too greedy or not?
Do I believe that what?
Do you believe that they are too greedy? Do they?
Yes. So the venture capitalists, particularly venture capitalists, so they are sort of greedy in the sense that a lot of them, venture capitalists, will spread their money across different ventures. So they'll form, for instance, private equity funds and so on, and use the money to spread across different ventures. Because the failure rate is so high, right? They tend to now say, well, let us jack up, right, the discount rate to compensate us for those firms that fail. So they typically would think out of every 10 firms they invest in, right, what will happen is they'll end up with 2 that are stars, right? And they'll end up with maybe 2 that are sort of okay, and 6 of them will just sort of fail outright. And these are even good numbers, but it's because they have had experience in analyzing, shall we say, firms. But with that itself, if only 2 are going to be real stars, 2 are going to be okay, and 6 you're going to lose money on, they feel they should be compensated then for that sort of extra risk. I think they are a little bit too greedy on that front, but that's sort of that's just my opinion. Okay. That's just my opinion.
Yeah. Okay. So we have started at Birmingham University a small business center to support the existing businesses as well, and provide marketing, strategic management, and financial support in terms of analysis, in terms of working on business plan, and so on. So what would be your advice in terms of focus for the small business center? Should we target 3 main areas of failures of attrition rate of small businesses, or say strategic, marketing, finance, or what would be your advice to us?
Yes. So I mean, I think those 3 areas are probably the most important. The finance, of course, is going to help. The firm cannot survive without adequate financing. It can't get off the ground. So that's important, very important. The marketing is to help them essentially. Really, the marketing is more to help the growth part, but also to get them off the ground. And then the strategic part of it. So we have a program at BICET called the Growth Catalyst Program. And so the strategic part actually comes in when they have reached a certain point and they are ready to actually start growing. In essence, when they're ready to exercise that expansion option and start growing rapidly. At that point in time, the entrepreneurs often don't have the complete skill sets to manage a high growth company. Right? So sometimes they end up growing themselves out of business. They take too many orders. They don't have the cash flow to produce these orders and so on. So helping them, manage all of that strategic part is good, but that comes in at that growth phase. So.
Okay, I'm taking questions. I'm waiting for hands or any questions in the chat. so that would not be a monologue between Dr. Osakwe and myself. Is it too late to ask questions? Okay, as if not, I'm going to ask the last one, and that would be, as you were presenting, I was taking notes and I'm thinking as well. And what are that one statistics that kept coming to my mind is that there is that 53%, according to official statistics in Canada, 53% of attrition rate of FMEs before they reach the age of 5. So when they feel like that, have they feel because they exercise their abandonment option, or is it because of some other issues and dealing with strategic marketing or financial management at all?
Yes. So in fact, entrepreneurs are actually reluctant to exercise the abandonment option. That is, they want to sort of keep going. And if the venture capitalists, for instance, don't stage the financing, right, then the entrepreneur will just keep going. If they give them all the money up front, they'll keep going way beyond the point where they should have shut down operations. I think that there's different reasons in the literature for why essentially that these new ventures essentially don't last. The attrition rate is so high for going beyond 5 years. But I think it is a strategic management issue. Okay, I think if you've lasted the first couple of years, first 3 years, and so on, then you often should be able to continue. I don't know what the conditional statistics are. That is, given that you've been operational for say 3 years, what's the likelihood that you would fail in the next 2 years? I don't know what that conditional statistic is. It actually will be an interesting study if there's nothing out there on that.
Yeah, that's perfect. So it's 8:09, about 1 hour since we have been in the air. So Dr. Osakwe, and on behalf of the School of Business at Birmingham University, the Small Business Center in particular, I want to thank you. That was an excellent presentation. I would take that conversation going because I myself teach finance over here. So, I have a lot of clues in terms of seeking appropriate experiential learning ground for students, because the Small Business Center would use students' knowledge and as well to support businesses. And I hope that this is not the last time we have that conversation, and in the context of the Small Business Center's activity. Again, on behalf of Birmingham University's administration, the School of Business and the Small Business Center, my colleagues here, I want to thank you and thank everybody and for participation in the meeting tonight. And that was organized in the context of Canadian Small Business Week. Again, thank you. We'll stay in touch, and we will continue that conversation and seeking support for SMEs in Canada.
Well, thank you for inviting me.
Thank you. All right.